In this video, let's talk about the income statement of your business plan, which is the second of the three major sections of the financials of your business plan. This is only a little bit more complicated than the cash flow statement, because the cash flow statement only takes into account the cash that's going in and out of your business, and that's revenue or expenses. So it's direct flows of revenue or expenses in and out of your business. The only difference between that and the income statement is that the income statement takes a look at more items that are going in and out of your statement. For example, interest that you might accrue, loans, stock investments or losses. So the income statement gives a fuller financial picture. And sometimes when in a cash flow, you might have a negative cash flow for a month, like we had in our previous example. Sometimes other items on the list, like we'll see here, can make your business profitable. For example, you see that for this example, I added, you get some bank interest, some real estate interest, customer loan interest, and stock investments, right? Profitable. And that pushed the overall income to overall revenue, not income, sorry, to $19,850. Whereas I also had some additional losses, some depreciation, some donations, some investment losses. And so that bumped up the losses as well. But the revenue was more than that, which actually made the business profitable. And that's the only difference between the income statement and the cash flow statement, is that the income statement has these additional non-direct revenue and non-direct expense items on it. So it gives the full picture of your profitability that particular time for that particular time period. And again, for most small businesses, when you're starting out, you want to be doing this monthly. Large companies, publicly traded companies, they do it quarterly, just so you can get a sense of the health of your business. I recommend that you do this monthly.